of performance. And now what I can do is I can take a weighted average of those. So the current week makes us come up with strength. So I put that on an index scale, and that gives me strength. And then consistency allows me to look at weeks 1 through 10, and I'm going to use a slightly weighted average. What I do, this is the math that you use for that. What I wanted the current week and last week to have a weighted value of 2. I use a modified weighted average. I take the index value of this week and last week and give it a weighting of 2. And then 9 weeks ago and 10 weeks ago, I give that a weighted value of 1. And then 7 and 8 is 1.25. 5 and 6 weeks is 1.5. And then 3 and 4 weeks is 1.75. So this is the most current performance is worth twice as much as the oldest performance. So that is a form of weighted moving average. The way you calculate that is that you sum those factors and then you divide. So this one has 2/15, 2/15, and etc. You use that to multiply for consistency. Now it turns out that when I do it, the index values are computed up in here. I can tell you that there's about 300 ETFs in this complete stack. Goes all the way down to ZZZ or something like that, right? And the idea there is if I take the 300 most liquid ETFs and I start laying them out on the world, what I'm going to do is have the entire world of investable securities covered by at least one of those ETFs, which I can own. And now what I can do is I can find the average performance, I can find the max and the min, and then I can decide where inside that stack I want to be. And then it turns out that on a score between 100 and 0, and this is an error trapper that tells me the math is correct, that the best performing ETF has an index value of 100 and the worst one has a value of 0. The average performance is 53.65. And then when I add and subtract one standard deviation, I get 70 and 37. So that tells me that if I want to be in the green, the top 15% of ETFs, I have to find things with a strength value better than 70. Check or hold. So now when I go to my weekend report, one of the things that you can see that I'm doing on my blended monthly rebalancing portfolios is that I'm taking the 3-month performance and the 6-month performance, multiplying that by 0.7 and 0.3, and I'm coming up with the blended performance. This column supports the blended monthly rebalancing calculation because that's how I come up with the blended 3-month and 6-month performances. And then for the ETF 13 portfolio, that's 13 ETFs that cover the world. I can divide it into those four categories. So of those 13, small caps and tech are the ones that are exceptionally outperforming compared to just this stack of 13. But I was also interested in the short-term momentum. So since I'm already computing the weekly performance, I do what's it done for the most current week and then for the last 4 weeks. Because there's also some interesting factors that come out there, like emerging markets over the last 3 months was horrible, but over the last month was excellent. Now you can see the inverse correlation of momentum happening. But when you start looking at longer term performance, it tends to be really bad. So you end up getting a dividing line between core and swing just on this simple table. Looking at 1 week, 1 month, 3 months, and 6 months, you start getting a very useful view of what's available. So now if I take the ETF 13 portfolio, let's take a look at what's in there. I have if I run it this way, I have US technology. So I have value, blend, and growth. I have large cap, mid cap, small cap inside the US. And then if I have EFA and the rest of the world down here, look what's really doing the best. Any mid cap, any small cap, that's IWM, is this one. IWM is doing really great. And technology in the form of the Qs is doing really well. So large cap growth US is represented by QQQ. And all the small caps are represented by IWM. So all other things being equal, I can own that and get this blended performance compared to everything else. Well, I get MDY in the mid caps for the US. I get SPY as the large cap blend and the best proxy for stable, secure, blended equities. And then I have DIA here. So it turns out that the top 5 performers out of 13 are all the US. So in the battle of the US versus the world, the US is winning. Look what I have for the globals. I have EWJ for Japan. So now if I look at the world and I have the US, I have 1, 2, 3, 4, 5 US symbols in here. I have for the globals, I have Japan. I have Australia because this is so strongly based on commodities, it actually gives me exposure to basic materials and commodities and not the US. I have the euro. I have the Asia euro blend. That's the large caps of the world, but not the US. I have Latin America to represent the Western Hemisphere. So it's Western Hemisphere. It's not the US and it's not the Euro Asia mix. I have EPP, which is Asia less Japan. So I can distinguish in terms of Asia, Asia or Japan. And then I have treasuries because it's not equities. And I have US real estate because that's such a large repository of value that all of the foreign countries, when they make excessive money, where do they like to put it for long-term safety and security? Into the real estate of the US. And that's why US real estate, which pays a nice dividend, is an alternate asset class compared to the S&P. I can look at US real estate separate and distinct from the US equities. So in a simple matter of 13 ETFs, I can get some real distinction between different parts of the world market model. Check or hold. If I then take the ETF 13 and then I take the US S&P 500 and I break that out into the 10 components or the nine components of XLB: materials, energy, finance, industrials, technology, staples. Let's see. Uh, yeah, industrials, utilities. Oops, get that. And then consumer discretionary. I'm missing one. So C D E F G H I J M N O P. And there's one that I'm missing in there. But I now get ETF 13 plus 9 sector spiders. I get ETF 22. So I get right now finance and technology. Those two elements of the S&P are outperforming small caps and technology. And this argues for why, if I get the top 3 of the S&P, I'm getting this kind of blended performance compared to the S&P, which is returning 13% blended. So the extra juice of the ones that are in the top third are giving me an extra plus 3%. Whereas if I look at the worst performers, utilities and energy, those things are only basically flat. So look at how strong finance, tech, and industrials are: 13%, 15%, 16%, compared to the 3 worst, which are 0, 0, and 4. So if I avoid the worst ones and double weight the best ones, I'm getting better than the blended performance of the S&P. So that gives you a reason to add a little more complexity to the model. If I take the ETF 22 and carry that forward and get to the 32, what I'm doing, I'm adding another 10 symbols like the European 350, silver, gold, Brazil, agriculture, clean energy, blended commodities. Now, DBC is an interesting one because that's based on 4 commodities, and this is an index run by the Deutsche Bank. So they have DBA, which is agriculture. They have energy. They have base metals, and they have precious metals. And then they take an equal blend of those 4. So this is industrial metals. This is precious metals: gold, silver, platinum. These are all the grains and pork bellies and coffee. And then this is the energy complex. You blend all that and you get DBC. So with a single commodity index tracking fund, you can own all of the commodities. You could own individual elements. So like DBA should be in here somewhere. Yeah, oh, there's DBA. So DBA is down 1.7. DBC is down 10% on the blend. So that represents non-equities. Those are the commodity elements. So ETF 32 is the blend of US and globals, plus the 9-sector spiders, plus a mix of these other, in some cases, countries, in some cases, um, sliced and diced commodities, and so forth. Well, why don't these last three not fall into the category of 3-year underperformance? Well, the reason is if I am rebalancing my portfolios on a weekly, monthly, quarterly, and annual, there's no way that I will miss the 3 to 5 year rotation. It just takes too long. I'm 66 years old. I can't wait 3 years and 5 years before I make my next decision and then find out, what if this thing started changing 1 month from now? What if blended commodities in China started to become amazing? Like China had already had an amazing recovery. That might be the first week and first month of what's going to be a 3 to 5 year outperformance. I can't afford to wait 3 years minimum to discover that China's been amazing for 3 years and only now am I going to start buying it? So it turns out that by looking at the weekly, monthly, and even quarterly, I can't miss the 3 to 5 year outperformance. And if you wanted to, you could run that separately. But for a core asset allocator, I'm not going to go to sleep for 3 to 5 years and then wake up and see what's going on. I'm going to be making my adjustments on a weekly and a monthly basis because it only takes me a couple minutes to do it. And if there's no change, then there's no change. What if for the next 150 weeks, the US, which is crushing it, what if the US continues to outperform the world for the next 3 years? And it only takes me 1 minute a week. And I see next week, the 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 US gets all the way through and for the next 3 years continues to outperform. I'm not going to go to sleep for 3 years and then see how the US is doing 3 years from now. I'm willing to invest 1 minute a week for 156 weeks at the cost of 156 minutes. I don't have to go to sleep for 3 years. That's why. So every 3 to 5 year mega cycle is going to be reflected in outperformance over one of those time periods, and you will get in front of it by the time it has 3 month outperformance and starts to cool off. As soon as it cools off enough, you'll get out of that in 2 or 3 weeks or a month or so. You don't have to wait 3 full years. So if you think about that for a while, you'll realize why that's smart. So now what I'm going to do is, by using this categorization scheme for 3 and 6 month blend to become the strength, and then using a 10-week average of strength, I can get consistency. Then what I'm going to do is I'm going to go to the quality, and I'm going to use a completely different method of analyzing. The yardstick I look here is I take a look at 40 weeks of performance. And I treat that as 40 1-week trades. So I take the last week and all the way out to 40 trades. And I treat that like 40 individual trades. Check or hold? Now, if I have 40 weeks, I can perform a system quality number analysis on it. I can, and the way I'm going to do that is I'm going to take the average percent gain, which is the expectancy, and I'm going to divide it by the standard deviation. That's how you get SQN. Check or hold? All I got to do is take the average of 40 weekly trades, and I get the average percentage. And then I take the standard deviation of those gains, and I divide it by that, and that gives me the SQN. So for all of these symbols, all 300 ETFs, I'm computing the SQN of all of them, and then I'm ranking those again, max to min to average, and I'm scoring that between 0 and 100. So I convert the SQN to the index score of available SQNs. And then that gives me the quality score. And then I color code that based on, I take the scores in each one of these. You notice that they're color coded green, white, yellow, and red. All I'm doing there is I'm taking the index scores, finding the average and plus one standard deviation, and coding that as white. I'm sorry, yeah, under the strength column. These are all the ones that are above average. This set right here is the set on current strength that are better than the database average plus one standard deviation. That's all. And then these are the ones, then on the consistency, the ones in green are above one standard deviation above average on the consistency. And then quality, I want you to notice, has a little more distinction. One of the reasons you get a low quality score, a low SQN, is because of you could have a very high percent average win, but the volatility could be large. So this is the case where biotech has had enormous gains. It's the strongest one in the database, but it goes from worst to best. And so it has a large volatility. So when you take gains and divide it by volatility, yeah, you get great gains, but you got bad volatility. So his quality score is lower compared to something like a simple large cap growth index, which for 150 weeks has been amazingly good and has had not a lot of volatility. It's been chugging along. So it gets a great SQN score. So this is a way on a simple table using strength, consistency, and quality. You can pick the thing that you want to value. All I do is I take the average. That's the arithmetic average of those three. If I add 100 and 90 and 47 and divide it by 3, I get 79. So the strength column actually represents their score on the blended monthly rebalancing. This one gives you a blended value that includes growth divided by volatility, and then consistency gives you a 10-week weighted moving average of strength. I really like consistency. So now off of those four simple columns, what I can do is I can build out these sets of swing strategies.